Have you ever wondered why, despite years of trading experience, your portfolio hasn't grown exponentially the way legendary traders' accounts seem to? Why is it that so many of us remain trapped in the cycle of modest gains, followed by devastating losses that leave us right back where we started? The answer might surprise you, and it has nothing to do with complex indicators, sophisticated algorithms, or expensive trading systems. The true differentiator between average traders and market titans lies in something far more fundamental: their psychological approach to risk and reward. Most of us enter the market with a single overwhelming priority: not to lose money. This defensive posture dictates everything we do. We snatch small profits quickly, terrified they might evaporate if we wait too long. Meanwhile, we cling desperately to losing positions, convincing ourselves they'll eventually recover if we just hold on tight enough. Has this ever happened to you? That sinking feeling as you watch a losing trade drain your account while you stubbornly refuse to exit? But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Stay with me until the end, because what you're about to discover might completely transform how you approach the markets forever. The greatest fortunes in market history weren't built through countless small wins. They were created through a handful of extraordinary trades where market legends positioned themselves perfectly for massive movements. Richard Wyckoff understood this profound truth over a century ago, developing what might be the most powerful yet misunderstood trading strategy ever conceived: pyramiding. Contrary to what you might have heard, pyramiding isn't reckless gambling or doubling down on hope. It's a disciplined, calculated approach to offensive speculation, a method for transforming modest investments into life-changing fortunes by compounding the power of correct decisions. While the average trader operates from a place of fear, constantly defending their capital through hesitant, half-committed trades, Wyckoff recognized that true wealth accumulation requires a completely different mindset. The secret isn't in timidly preserving what you have. It's in aggressively maximizing your correct judgments when the market confirms your analysis. This distinction between defense and offense, between preservation and multiplication, forms the cornerstone of Wyckoff's trading philosophy. His pyramiding strategy doesn't require you to be right more often. It requires you to be extraordinarily right when it truly matters, and to capitalize on those moments with strategic precision. What if you could turn a small $1,000 position into $100,000, not through blind luck or reckless betting, but through a methodical process that systematically compounds your winners while strictly limiting your losers? What if the very structure of your trading approach could transform occasional market insights into exponential returns? If you're serious about mastering trading psychology and strategic position building, hit subscribe now to join our community of disciplined traders. To truly grasp the transformative power of Wyckoff's pyramiding strategy, we must first confront its destructive opposite, a practice that has sabotaged more trading accounts than perhaps any other mistake in market history. I'm talking about averaging down, the seemingly logical but devastatingly flawed approach of buying more shares as a position moves against you. This hidden truth lurks behind countless trading failures. The scenario plays out with remarkable consistency. A trader buys a stock at $50, convinced of its potential. The next day, it drops to $47. Rather than questioning their analysis or accepting a small loss, they double down, buying more shares to improve their average price to $48.50. The reasoning appears sound on the surface. If it was a good buy at $50, it must be an even better bargain at $47. But this decision represents a profound mindset error that Wyckoff identified as the cardinal sin of speculation. It's a psychological trap that has destroyed countless fortunes and trading journeys. What's really happening in this moment is not a rational investment decision, but an emotional reaction, a desperate attempt to avoid facing an uncomfortable reality. The revelation that Wyckoff understood with crystal clarity is that averaging down is rarely about market analysis. It's about ego protection. When we average down, we're not buying more because our judgment has been confirmed. We're buying more precisely because our judgment has been challenged, and our ego cannot bear the weight of being wrong. We're sending good money after bad, not for sound financial reasons, but to protect our self-image as competent decision-makers. Wyckoff viewed this behavior with absolute contempt. He understood the psychological impact of this common mistake, how it transforms a manageable small loss into a potentially catastrophic one. He wrote with brutal honesty about this practice. Great numbers of people will buy a stock at 50, and 2 or 3 days later, if they can buy it at 47, they are seized with the urge to average down. Having bought at 50 and being concerned over a 3-point loss on 100 shares, what rhyme or reason is there in adding another 100 shares and having double the worry when the price hits 44? The logic is inescapable. If losing $300 on 100 shares caused concern, why would doubling the position and risking $600 be any better? It's not investment strategy, it's emotional self-sabotage disguised as prudent money management. This behavior marks the profound difference between amateur and professional traders. The amateur operates from hope, wishing the market will reverse to validate their original decision. The professional operates from evidence, demanding the market confirm their analysis before committing additional capital. Now I want to go even deeper into understanding the psychological framework that drives these decisions, and how Wyckoff's alternative approach creates a completely different outcome. If you've ever caught yourself averaging down on a losing position, write in the comments, "I'm breaking this habit." Acknowledging this tendency is the first step toward financial transformation. The psychology behind averaging down reveals a profound truth about human nature that extends far beyond the markets. When we average down, we're not making a strategic decision. We're surrendering to 3 powerful psychological weaknesses that sabotage our financial journey. First, there's the overwhelming desire to be proven right. Taking a loss is a direct admission of error, a blow to our ego that many find unbearable. Averaging down allows us to postpone that painful admission, telling ourselves, "I'm not wrong, I'm just early." A comforting illusion that delays but ultimately magnifies the inevitable reckoning. Second, we encounter the paralyzing fear of crystallizing a loss. As long as the position remains open, the loss exists only on paper. A psychological limbo that feels less painful than the finality of closing the trade. This fear keeps traders trapped in positions that continually deteriorate, unable to make the clean break that would free both their capital and their mental energy. Third, we fall victim to the mathematical mirage of a better average price. The calculations seem compelling on the surface. My average is now lower, so I need less of a recovery to break even. But this masks the fundamental revelation that matters most. The trader isn't improving their position. They're dramatically increasing their risk. The market doesn't care about your average price. It moves according to its own internal dynamics. The hidden truth is that hope becomes the deadliest enemy of the speculator. Those who average down are substituting wishful thinking for strategic planning. They hope the market will reverse, their judgment will be vindicated, and they can escape their predicament. But markets rarely reward hope. They reward precision, discipline, and alignment with dominant forces. This brings us to the transformative first principle of Wyckoff's pyramiding strategy, which stands in direct opposition to averaging down. Always buy on a rising scale. This isn't just a technique, it's a complete mindset shift that revolutionizes how you interact with the market. The foundational rule is elegantly simple, yet profoundly powerful. Each succeeding purchase must be at a higher price than the previous one. Where averaging down fights against the market's verdict, buying on a rising scale embraces it. This approach creates perfect alignment between your actions and the market's dominant direction. Think about the psychological impact of this approach. When you buy at higher prices, you're not making blind guesses or hopeful pleas. You're responding to market validation of your initial judgment. The market itself is telling you that you're right through its most honest communication channel, price action. Each new purchase at a higher price is made with greater certainty than the one before. Rather than risk increasing with each additional buy, as happens when averaging down, risk is actually being progressively validated. You're not becoming more aggressive. You're deploying your capital more intelligently, committing more resources only as the evidence of success mounts. Let's explore how this principle transforms into practical action in real market conditions. If you've experienced the revelation that buying higher can actually be safer than buying lower, type "higher is safer" in the comments. It's a counterintuitive truth that marks the beginning of trading mastery. The fundamental revelation at the heart of Wyckoff's approach is a profound shift in how we perceive our relationship with the market. Most traders enter the arena with an adversarial mindset, attempting to impose their will on price movements. They analyze, predict, and then expect the market to conform to their expectations. When it doesn't, they double down, fighting against the very forces they should be respecting. The professional speculator understands a deeper truth. Their job is not to conquer the market, but to align themselves with its dominant forces. This perspective transformation completely changes how you interact with price action. Instead of battling against the current, you learn to recognize which way the river is flowing and position your boat accordingly. When a stock is advancing, it's communicating something essential about its internal dynamics. Buying pressure exceeds selling pressure. The path of least resistance is upward. This isn't just technical jargon. It's the market revealing its true character through its most honest language, price. Each new higher stock makes isn't just a number on a chart. It's further evidence of underlying strength, a confirmation of the bullish narrative playing out in real time. Subscribe now for more timeless trading wisdom that transforms small accounts into significant wealth. Just like Wyckoff taught, this revelation leads to a counterintuitive insight that challenges conventional wisdom. Each additional purchase at a higher price is actually made with greater certainty than the one before it. The risk isn't increasing as the price rises. It's actually being progressively validated by the market itself. You're not becoming more reckless by buying higher. You're responding intelligently to mounting evidence of correctness. Now, let's explore the practical mechanics behind this philosophy, how Wyckoff's pyramiding strategy unfolds in the real world as a methodical campaign rather than a single speculative gamble. The journey begins with a small exploratory position, perhaps 100 shares of a stock showing promising characteristics. This initial purchase isn't your final commitment. It's the first probe in what might become a much larger campaign if the market validates your analysis. The key distinction here is that you're not immediately deploying your full capital on a single conviction. You're testing the waters, giving the market a chance to respond to your thesis. As the stock advances, confirming your initial judgment, you begin the pyramiding process by adding another 100 shares at a higher price. Each subsequent addition is made only after the market has advanced further, providing additional evidence that your analysis is correct. The position grows organically in response to market feedback, not based on predetermined allocations or arbitrary rules. This methodical approach transforms speculation from a single high-stakes gamble into a logical, evidence-based campaign. Rather than making one large bet based on your opinion, you're initiating a series of smaller conditional investments, each contingent on the success of the previous one. The goal isn't simply to be in the market, it's to have significant size only when the market is moving decisively in your favor. The beauty of this approach lies in its harmony with both market dynamics and human psychology. By starting small and scaling into winning positions, you create a natural alignment between position size and conviction level. Your largest positions aren't based on hope or opinion. They're built on the foundation of demonstrated market strength. Let's examine how this pyramiding process creates a completely different psychological experience for the trader. If you've had that aha moment about aligning with the market rather than fighting against it, write "I flow with the market" in the comments. It marks the beginning of a profound shift in your trading approach. Now we arrive at the second critical principle of Wyckoff's pyramiding strategy, a revelation that challenges how most traders enter positions. This principle might seem counterintuitive at first, yet it forms the essential gateway to the entire approach. Your very first trade must show a profit. If this initial commitment fails to deliver immediate gains, the pyramid is never built. This insight emerged from Wyckoff's own transformative journey through the markets. After years of painful lessons and costly mistakes, he discovered a profound truth. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity, showing a profit right from the start. Think about the paradigm shift this represents. Most traders enter a position and immediately begin wondering how much pain they should endure before accepting defeat. They set stop losses based on arbitrary percentages or support levels, preparing themselves psychologically for the potential downside. But Wyckoff flipped this entire framework on its head. He viewed his first entry not as a definitive position, but as an exploratory probe, a test sent out to answer one critical question: is my timing correct? The market's immediate response to your initial purchase contains invaluable intelligence. When you buy a stock and it immediately advances, that's not just a pleasant coincidence, it's validation. The market is confirming your analysis through its most honest communication channel: price action. This immediate profit isn't just about making money, it's about proving that your timing is aligned with the market's intentions. Conversely, if you buy a stock and it immediately declines or simply does nothing, that's equally valuable feedback. The market is telling you something essential about your timing: not now. This signals a misalignment between your analysis and current market conditions. The authentic breakthrough in Wyckoff's approach comes in how he responded to this feedback. If the initial position failed to show immediate profit, he didn't wait for recovery, didn't average down, and certainly didn't hope for a reversal. His response was decisive and ego-free. Close the trade immediately, take the small predefined loss, and step back to reassess. I was wrong, he would conclude. It might be I was only temporarily wrong. But it does not pay to start wrong in anything. This disciplined response transforms the initial exploratory trade into the primary risk control mechanism for the entire pyramiding strategy. It ensures that any losses remain small and contained, while only positions that are immediately proven correct are allowed to grow. This approach requires a level of humility and flexibility that most traders struggle to develop. It demands the courage to admit when your timing is off and the discipline to act swiftly rather than hope for improvement. It completely reframes how we think about market entries, not as final commitments based on conviction, but as testable hypotheses subject to immediate market validation. The behind-the-scenes psychology of this principle is what makes it so powerful. By requiring immediate confirmation before expanding a position, you're establishing a standard of evidence-based decision-making rather than hope-based speculation. You're training yourself to respond to what the market is actually doing rather than what you believe it should do. Let's examine how this principle combines with the first to create a complete framework for position management that dramatically differs from conventional approaches. If you've experienced that moment when the market immediately confirms your entry with a quick profit, type "confirmation is key" in the comments. It's that signal from the market that you might be onto something significant. When these two principles combine, buying on a rising scale and requiring immediate confirmation, they create a complete framework that fundamentally transforms how you approach the markets. This transformation represents the critical shift from amateur to professional trading, and it centers around a profound revelation. The goal isn't to avoid all losses, but to ensure that wins are exponentially larger than losses. This insight changes everything. Most traders obsess over win rate, believing success comes from being right as often as possible. They celebrate small victories while allowing devastating losses to accumulate. Wyckoff understood the hidden truth. Lasting success comes from asymmetry, not frequency. A 40% win rate with winners 5 times larger than losers creates extraordinary returns, while a 70% win rate with winners and losers of equal size leads to mediocrity or ruin. Pyramiding is the mechanical tool that creates this essential asymmetry. It's the system that transforms small, correct judgments into massive, life-changing profits. Rather than focusing defensively on minimizing losses, it takes an offensive approach to maximizing gains. When combined with strict initial risk control, the result is a strategy that limits downside while allowing unlimited upside, the perfect asymmetric bet. Consider the journey this creates. You enter with a small, exploratory position. If it immediately shows a profit, you add more at higher prices as the market validates your judgment. Each addition comes after further confirmation, building your position in harmony with the market's own strength. Your largest position size coincides precisely with your highest level of certainty, a beautiful alignment that most trading approaches fail to achieve. But this still leaves a critical question unanswered. When exactly should you begin this pyramiding campaign? The timing element is crucial, as starting too early or too late can dramatically impact results. This is where Wyckoff's methodology provides an invaluable framework that perfectly complements the pyramiding strategy. Wyckoff discovered a revelation that changed how he viewed market movements. Major trends don't happen randomly. They're preceded by recognizable periods of preparation, specific patterns and behaviors that signal the market's readiness for a significant move. His analysis of market phases, particularly the transition from sideways accumulation to powerful trending markup phases, identifies the ideal moment to begin pyramiding. During accumulation, smart money quietly absorbs shares from weaker hands, creating specific footprints in price and volume that the trained eye can recognize. When this accumulation is complete and the markup phase begins, that's precisely when the pyramiding strategy can be applied with explosive results. The behind-the-scenes advantage this creates is immense. While most traders try to pyramid any stock that's already in motion, often near the end of its move, the trader who can identify the signs of Wyckoff accumulation can position themselves at the very beginning of the trend. They can build their pyramid from the ground floor rather than trying to add floors to a structure that's already near completion. The synergy between these approaches is powerful. Wyckoff gives you the map to find the starting line of the race, while pyramiding gives you the strategy to run that race with maximum speed and profit potential. Let's explore exactly how. To identify these critical market phases where pyramiding becomes most effective. If you've noticed how the biggest market moves seem to come out of periods of quiet consolidation before exploding higher, write, "I see the accumulation" in the comments. You're already developing the eye for Wyckoff's most powerful pattern. The foundational principles of pyramiding, buying on a rising scale and requiring immediate confirmation, are powerful on their own. But transforming a modest $1,000 stake into a life-changing $100,000 fortune requires something more, a masterful integration of both mechanics and psychology into a cohesive methodology that can be applied with precision and conviction. This journey of transformation isn't just about understanding concepts intellectually. It demands a deep integration of technical expertise and psychological discipline. Wyckoff spent decades refining these elements through trial and error, painful losses, and extraordinary victories. The revelation he discovered was that successful pyramiding requires three critical components working in harmony: precise timing for when to begin, systematic risk management as positions grow, and the mental fortitude to hold through inevitable market fluctuations. Of these elements, perhaps none is more crucial than the first, knowing exactly when to initiate your pyramiding campaign. Enter too early into a market that isn't ready to move, and you'll experience a small loss and a missed opportunity. Enter too late, and you'll miss the essential backlog of profit that provides both financial cushion and psychological courage for the journey ahead. This brings us to one of Wyckoff's most powerful insights, the concept of the pivotal point. This is the specific moment when the market signals its readiness for a major, sustained move. As he wrote, "Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations." A pivotal point isn't a subjective guess or a hopeful prediction. It's a specific price level with historical or psychological significance that, when decisively breached, indicates that the balance of power between buyers and sellers has fundamentally shifted. It's the market's own declaration that the line of least resistance is now clearly established. Wyckoff identified several types of these critical pivot points. The most recognizable are major round number barriers. Prices like 50, 100, 200, or 300. He observed that after a stock passes such a level for the first time, a fast and straight movement almost invariably occurred. These psychological barriers, once broken, often lead to accelerated momentum as new buyers enter and hesitant sellers capitulate. Another powerful pivotal point is a brand new high price for a stock that has been dormant for an extended period. This signal suggests that something fundamentally positive has changed with the company, and that all previous overhead resistance has been overcome. Usually, it is a safe play to buy the minute it touches a brand new high, Wyckoff advised after witnessing this pattern repeatedly throughout his career. The revelation behind waiting for these pivotal points is profound. It allows you to avoid the frustrating and capital-draining experience of being locked in a get-nowhere market. Wyckoff would not commit even his first exploratory share until the market itself had given him this clear and unambiguous starting signal. This patient, disciplined approach stands in stark contrast to the frenetic activity of most traders, who jump in and out of positions based on minor fluctuations or subjective analyses. Wyckoff understood that great fortunes aren't made by constantly trading. They're made by positioning yourself precisely at the moments when the market is ready for significant movement. Let's examine how this concept of pivotal points integrates with the pyramiding. Strategy to create a complete trading system. If you've noticed how stocks often accelerate dramatically after breaking through major round numbers like 50, 100 or 200, type pivot points revealed in the comments. You're recognizing one of the market's most powerful signals. Now let's explore one of the most profound revelations about pyramiding that dispels a common misconception. Many traders view pyramiding as a form of reckless gambling, an irresponsible doubling down that magnifies risk to dangerous levels. Nothing could be further from the truth. When executed correctly following Wyckoff's methodology, pyramiding is actually a sophisticated form of risk management that offers remarkable protection for your original capital. The hidden truth that transforms how we understand this strategy lies in where the money for additional purchases comes from. In Wyckoff's approach, the trader's original capital is only at significant risk on the very first trade. Every subsequent addition to the position is financed not from the trader's pocket, but from the market's money, the paper profits generated by the initial successful trade. Let's illustrate this transformation with a concrete example. A trader identifies a stock at a pivotal point of $50 and makes their first exploratory purchase of 20 shares, risking $1,000 of their original capital. Their maximum risk is clearly defined, perhaps a stop loss at $48, limiting potential loss to $40 plus commissions. The stock behaves as anticipated and advances to $52. This initial position now shows a profit of $40, providing validation of the trader's analysis. Now comes the second purchase, another 20 shares at $52. The total position becomes 40 shares with an average price of $51. As the stock continues its journey upward to $54, the entire position is now worth $2,160 against a total cost of $2,040, creating a paper profit cushion of $120. Notice the paradigm shift that has occurred. The trader has doubled their position, but their original $1,000 is no longer at significant risk. The profit serves as a buffer, allowing them to move their stop loss up to their average cost of $51, ensuring that at worst, they'll break even on the entire campaign. This process continues as the stock advances. With each new addition at higher prices, the stop loss is raised to protect accumulated gains. The pyramid is built not by adding risk, but by compounding a correct judgment while systematically removing risk to the original capital. This is the opposite of gambling. It's a calculated business method that demands continuous validation from the market itself. Yet, despite this mathematical protection, pyramiding still presents traders with perhaps the greatest challenge of all: the psychological battle of holding a large, profitable position through normal market reactions. It's one of the great ironies of trading that it's often far more difficult to hold a winning position than to cut a losing one. The amateur trader is tormented by the fear of losing paper profits. Every minor pullback feels like the beginning of a catastrophic reversal. The temptation to cash in and secure the gain becomes almost unbearable. This anxiety prevents most traders from capturing the truly great movements, the extended trends that transform small stakes into fortunes. Wyckoff understood this battle intimately, having fought it countless times throughout his career. The revelation he discovered was that the psychological stability required to sit tight comes directly from the structure of the pyramid itself. The backlog of profit that a correctly built pyramid provides creates both financial security and emotional courage. The trader who has pyramided their way into a large position from a low initial entry has a substantial profit cushion. When the stock experiences a natural reaction of a few points, they remain comfortably profitable. They can view the pullback dispassionately as a normal and healthy part of the trend, analyzing its character rather than panicking. Let's examine how these mechanics and psychological elements come together in real-world trading scenarios. If you've ever sold a winning position too early and watched in frustration as it continued higher without you, type "patience pays" in the comments. You've experienced firsthand the psychological challenge that Wyckoff's pyramiding strategy addresses. As we've explored Wyckoff's pyramiding strategy, we've uncovered a complete framework that transforms how you approach the markets, replacing fear with strategy, hope with evidence, and random action with methodical precision. The path from $1,000 to $100,000 isn't about luck or aggressive risk-taking. It's about respecting the market's authority while capitalizing decisively on correct judgments. The journey of mastering this approach doesn't end with understanding the concepts. It begins there. Implementing these principles requires practice, discipline, and a willingness to challenge your existing beliefs about market behavior. But the psychological and financial rewards are well worth the effort. If you found value in these insights today, I genuinely appreciate you hitting the like button. It helps others discover this content who might benefit from it too. And if you're committed to elevating your trading approach beyond the ordinary, subscribe to join our community of strategic traders who focus on evidence-based methods rather than emotional reactions. I'd love to hear your thoughts on pyramiding in the comments. If something clicked for you today, or you had an aha moment, simply write "The pyramid is built" in the comments. Your perspective adds tremendous value to our collective understanding. For those ready to take the next step, I've created a video exploring Wyckoff's accumulation phase in detail, the perfect foundation for identifying those pivotal points where pyramiding becomes most effective. You'll find it right here. Click through and continue your journey toward market mastery. Until next time, remember that the greatest fortunes aren't made by trading frequently. They're made by trading correctly at critical moments.